Welcome to episode 7 of my How I Trade ICTs concept series. In the previous video, we talked about top-down analysis, why it matters, the weekly chart, daily chart, 4-hour chart, 1-hour chart, and how I do my analysis and charting on all of those time frames. We talked about time frame alignment and how we could use a combination of certain time frames to help us in our analysis and predicting where the market is more than likely going to go. And then we had a basic introduction into the 20, 40, and 60-day IPTA look back and how we could use that for key liquidity levels that price will refer to. And then we talked about if then, if when statements and how we can use what we see in price or what we don't see in price to help us predict where the market is going to go. Now, I did go back and forth over the next set of videos to do after the top-down analysis video, and I was going to start digging into the models that I trade. However, I feel that it would be beneficial for you to know the time or times that I focus on price, because it's not the price that you should focus on, it's rather the time, because based on where price is at certain times or certain ranges, that will determine what the algorithm will revert back to or what the algorithm will focus on or use to target for liquidity or just use for market structure and how it'll move price throughout the day. And it's a big component of how I trade and how I view the market. So it looks like there's a lot here. However, I will try my best to go through it pretty quickly because it doesn't take a lot of time to talk about these. So we'll get into this. We're going to talk about the important times. We're going to talk about medium and high impact news drivers. We're going to talk about the ICT Killzones and sessions. We're going to talk about the new week and new day opening gaps. We're going to talk about monthly, weekly, and daily opens. We're going to talk about liquidity injection times. We're going to talk about silver bullet time windows. And then we're going to talk about time macros. I should probably preface this video by saying that all times are in New York Eastern time. For the remainder of this video, and anytime I'm trading live or anytime I'm calling out a time, the time will always be based on New York/Eastern time. So whatever part of the world you're in, I recommend you change those times to New York/Eastern time. Like, for example, I am stationed in the UK now, so I have British time. However, whenever I'm trading or I'm focusing on certain times or certain time-based ranges, I'm always looking at New York time because that's where the US stock market is based out of. So that's where the algorithms are going to base the time off of. The important times, the news embargo lift, so like these, I'm not really going to go and show it to you on the chart because it's just times. We don't have to go over like ranges or anything. It's just times for you to keep in mind throughout the day. And you don't want to forget these times, or you at least want to be cognizant or aware of these times because they do play a large role in moving price. But anyways, the news embargo lift is at 8:30 a.m. This is essentially when news is allowed to be posted. So if you look at the Forex Factory, which again we'll go into in a little bit, you'll notice that most of the time the first medium to high impact news of the day comes out at 8:30 a.m. And then we have the equities open, which is at 9:30 a.m. And then we have the equities close at 4 p.m. Equities open is essentially when everyone starts trading. That's when the bell rings at the New York stock market and, people are clapping because the trading session has officially started for the day. And then it closes at 4 p.m. The futures open is at 6 p.m. and then the futures closes at 5 p.m. And I'll go into that when we talk about the different sessions. And then we also have the London close, which is 10 a.m. to 12 p.m. That's the time window of when the AM sessions trend usually ends, or you'll get like a pullback or a reversal because the traders in the London stock market are taking profit or securing positions right before their market closes. So it's the same thing as the New York session. When the New York session is about to close at 4 p.m., you'll notice that there's usually a big move or a decent retracement or a reversal right before the market closes. And then we have the bond market closing hour. I don't really focus too much on this as an indices trader, but it is something to keep in mind because it does play into like the power hour, which is 3 p.m. to 4 p.m. of the New York session, which is essentially the last hour of trading before the market market closes. Now let's move into medium and high impact news drivers. Medium and high impact news drivers are basically anything that shows up on this schedule or this calendar. This is forexfactory.com. If you go to forexfactory.com/calendar, you'll be able to see this. Yours might be a little bit different if you're logging into it for the first time. I will show you how I have mine set up. If you come up here to the top portion where it has the time, you'll come over here and you'll change this to Eastern time, which is New York time. And I have mine set to AM, PM. Save settings. And then I filter out the yellow and the white folder news because I don't really care about that. It doesn't have as much market moving potential as the red and the orange do. So I keep those two unchecked. And then I only focus on USD because I'm really only focusing on the US market. And then I usually keep mine on this week. That way I could see everything that's coming up for the week ahead. And then I usually apply that. And that's essentially how I keep mine set up. Whenever the new week is about to start, you'll get the whole week's worth of news for that upcoming week. That way you can plan ahead as far as what days you're gonna take it easy and what days you're gonna look for volatility. Because these orange and red folder news events, they drive the market by inducing a lot of volatility. There's events that cause a lot more volatility than others, like for example, CPI, PPI, and non-farm payroll. Those are the big three that you do not want to be trading, or at least not have an open position during the release of those news events. Those will move the market a lot. You don't want to be caught on the wrong side of the market when those news events come out because you're going to have a really bad day. I like to keep track of when those events are going to happen, what days, what time, and I want to plan my trades around those events. Now, there are some times where you'll look at this on the weekend to get ready for the week ahead, and it has the list of what you see, and then you'll look at it again and you'll see stuff added or stuff changed. That does happen from time to time, so it is a good idea to check it throughout the day. But for the most part, they don't change very often. You will see sometimes President Trump will speak, or sometimes the Fed chair will be speaking at a random time. But like I said, as long as you check it once or twice a day, you should be good. Now we're going to move into the ICT Killzones /sessions. Depending on who you're talking to, they change slightly all the time. So if you Google ICT Killzones and sessions, you're going to get a lot of different answers. However, this is straight from ICT. We have the Asia session, London session, the New York AM session, the New York lunch session, the New York PM session, and that's pretty much it for sessions. Okay, these are the time-based ranges for ICT's sessions. So there's Asia, London, New York AM, New York lunch, and New York PM. And this is a whole trading day because you have the start at about 6 p.m. here all the way to market close at 4 o'clock, 5 o'clock, whichever market you're looking at, because equities closes at 4, futures closes at 5. So this is a whole 24 hours worth of trading, and these are the sessions in that entire 24 hours. Asia session is from 8 p.m. to midnight. London session is from 2 a.m. to 5 a.m. Don't worry about the data. New York AM session is 9:30 to noon, and then New York lunch is noon to 1:30, and then New York PM is 1:30 to 4 o'clock. When we start talking about the models that I trade and how I use them to formulate my trade, these are going to come in handy because this is essentially how I map where I predict the daily range is going to go, or where price is going to go throughout the day. I'm looking at these ranges, and that's the reason why I wanted to go over the time aspect before we went over the models and stuff. For example, I told you not to worry about the data because technically that's not really a range that ICT highlights. It's more or less using the news that comes out at 8:30 to formulate trades based on how the algorithm is going to move price based on that time-based range. 8:30 is usually when some of the high impact news drivers comes out in the morning. So I take that 30-minute range from 8:30 to 9 o'clock and I use that as a way to formulate trades or see how price is treating the range that forms in that 30-minute range to move price. So if you look at just this alone, we have our 8:30 to 9 o'clock time-based range here, but you'll see that price moves up after it forms it, rejects that, and then it comes down right to this, rejects that and heads right up. Super random. The same way price is using this range and extending standard deviations down and up, the way price is using that, we could use that for all of the other time-based ranges as well. These are the ranges that I focus on the entire day whenever I'm reading price and anticipating where it's more than likely going to go. More on that later. Okay, so moving on to new week opening gaps and new day opening gaps. So these are pretty easy. This chart is showing you the new day opening gaps and new week opening gaps for the past 5 days or 5 weeks. So you'll see that the NDOGs are in blue and the NWOGs are in orange. Now, the NWOG, or the new week opening gap, is the difference between the closing price on Fridays at it would be 4:59 p.m. and the opening price on Sunday at 6 p.m. Eastern time. That's the reason why the indicator is marking this out, because this is the entire NWOG for this past week. If you look at all the other ones, again, the difference in price between the close of Friday at 4:59 and the open on Sunday at 6 p.m. So the close of 4:59 is here. The open of 6 o'clock is up here. So the difference between that's the NWOG for the week. And then the NDOG is the same concept, except it's for the day. If you look over here, this is the NDOG from Monday into Tuesday. Well, Tuesday's trading session, because Tuesday's trading session actually starts at 6 the previous day. So the difference in price between the close on Monday at 4:59 p.m. and the open on Monday at 6 p.m. That's the NDOG right there. So that's why it's highlighting it. But that is essentially what the NWOG and the NDOGs are. And just like how I showed you how price reacted to that data time-based range, this is how you could use the NWOG or NDOG to formulate your trades based on what you're seeing in price. So for example, the close of Thursday was here, open of Friday technically is here, but price ran straight up at the open, took out, actually it didn't take out liquidity here. High is 771, high here is 770.75. So it stopped short of that liquidity here by 1 tick, quickly dropped, retraced up into the bottom of the NDOG, used it as resistance, and then we sold off. You could see how price reacts to these levels as we're moving through time. This NDOG from way back here, we went above it here, used it as support here, and then we used that as sort of like the liftoff pad to go higher. So this NDOG was kind of small, quickly went down, and then we got back above it, used it as support, went higher, and then we were also trading inside this NWOG, which was actually a touch back into it from the previous Friday. So this opened up, immediately went higher, and left it open. This was when we had the news of the deal between the US and Iran on the Strait of Hormuz and all that stuff. But yeah, we left it open all the way until Wednesday. So you could have used the NWOG as a target for your short trade. If you were looking for a short trade up here, you could have used the NWOG as a target. And then we bounced out of it after hitting the halfway point, went up, used the top of it as support, went higher, swept liquidity, displaced down, retraced up into the fair value gap, used that as resistance, sold off. This time we touched the bottom of the NWOG and then we used that. So now we're starting to inverse the NWOG because we already filled it down here. So the open that we left since Sunday's open got filled in here completely. And then we started working our way back up, and then we were bullish the rest of the week. These are how you can use these levels or time-based ranges to formulate your trade or anticipate where price is going to go next. And it's the same thing with the NDOGs. Okay, now we're going to talk about monthly, weekly, and daily opens. We're in June now, so we want to look at June's monthly open. June open, and then we're going to focus, we'll just go off of the 3 previous months. So this is the May open, and then we've got April open. Okay, so if we come down into the lower time frames, let's just say like the 15. So this is the opening price on June, and then we have consolidation, manipulation up, and then we have distribution all the way down, and then we started consolidating, and then we started reversing the trend to get back above the June open, retraced, and then now we're back near the June open. This is gonna be more beneficial for us when we go into how I trade using the models and all that, because I'm gonna talk about accumulation, manipulation, distribution, and the first presented fair value gap, and the market maker buy and market maker sell models. This will all play into the monthly, daily, weekly opens and how price is structuring as we move throughout the days. That's the reason why I wanted to go over the time-based stuff before we went into the models. But that's the June open. May open is over here. You can see May opened up here. We kind of just had like a small manipulation down before we started expanding higher. And then we have large expansion here, retrace back down to that May open in price. And then we started expanding up higher off of that. This is textbook accumulation, manipulation, distribution of the monthly candle. So you have open, low, high is way up here, high, and then close, because this is when May ended and June started. So if you look at the monthly chart, it should be a large May candle with very little manipulation. So again, small, we had the open, low, high, close, and then June opened up here, manipulated down, and then so far we're like right back close to where we opened up for June. And then it's the same thing for April. This is the same thing. We had a short manipulation leg to create the lower wick of April's monthly candle, and then we went higher because we had this drop down. We had a sweep of liquidity here, so this sweep down took out that, displaced higher, pulled back, expanded, and then April opened up, went higher, went lower, took out liquidity of April's low or April's open, created the lower wick, and then we started expanding higher. And then it's the same premise for every week, every day. We'll go to the previous week. So we have this current week, we have the previous week, and then we have, we'll just focus on those two. Weekly open, manipulation up. Because we didn't even touch back into the new week opening gap here at all before we started taking off, this whole thing I view as manipulation. On days or brand new weeks, whenever we open up and we just take off in one direction, I actually like that because I know that price is eventually going to come back down. And this is all just a trick. This is the manipulation at the beginning of the week, and then you could formulate a trade down back into that range or back down into that opening price, which is what it did here, and then it quickly reversed and went back out. That's the weekly open price for that. And then we also have the weekly opening price here. Almost the same setup, kind of just opened up, took off, and then look at this. This is high resistance liquidity because it's just very choppy, even though it's over the span of like a day, day and a half. And then all of a sudden, low resistance liquidity run just ate through everything back down into the weekly open, and then also dug into the previous week as well. And then we consolidated, and then we started going back higher. And then it's the same thing for the daily. I'm not really going to do it for you again because it's just repetitive at this point. But I will say that for the daily open, you can go off of the 6 p.m. or you can go off of the midnight. Most people, they like to focus on the midnight. I guess I'll just show it to you. I like to have both on my chart. I tend to put more emphasis on the midnight price. The open and midnight is there for this day, which is Friday. Midnight price for this particular day is right here. And then midnight price for this day is here. And you want to focus on the open and the close because you should be going off of the open price, not the close. And again, you could see how price treats that midnight price as it goes on. So, support, resistance, support. It's kind of just chopping up in between. So whenever it's like this, you don't want to take trades because it's just chopping people up. You want to take the clear trades off of this level. Rejection here, took out this again. So yeah, this day was particularly trash, but you could see how it uses price as levels to focus on, like this one, support, support here until we came back up into it. And then we sold off, used this one as support, blew past this one, kind of resisted this a little bit, and then we blasted through it and then didn't even touch it over here, and then we blasted up. And then it's the same thing for 6 o'clock. You could use 6 o'clock or midnight open, but like I said, I personally put more emphasis on the midnight price. So let's delete all these. Okay, moving forward, liquidity injection times, 12 a.m., 8:30 a.m., and 12 p.m. These are just times that liquidity is being injected into the market. So at these specific times, that's when the market makers are basically starting to build up a position. And you'll see that sometimes you'll chart out these times, 12 a.m., 8:30 a.m., and 12 p.m. And you'll notice that price will gravitate away from where these prices originate, and it'll create a swing, and then it'll come back. And then it'll sometimes even create a symmetrical swing in the opposite direction. For example, 12 a.m. will open up, it'll swing down, let's just say 200 points, and then it'll come back to 12 a.m. and then it'll extend upwards in the opposite direction 200 points. Sometimes you'll notice that, and it'll do it up and then down, or it'll do it down and then up. But more often than not, I just use these as targets. I don't really use it to map out symmetrical swings. I just pay attention to these specific times because price will tend to gravitate back to these specific times, because that's when the market makers are engineering liquidity, or they're injecting liquidity to start building up their position, and then that's when they start swinging it. So they'll swing it to an extreme high or low, they'll bring it back to that price, and then they'll swing it the opposite direction. Now we're going to talk about silver bullet time windows. There's 3 that ICT talks about. 3 a.m. to 4 a.m. is London. New York AM is 10 a.m. to 11 a.m. New York PM is 2 p.m. to 3 p.m. The bonus New York PM is 3 p.m. to 4 p.m. And ICT did mention this in one of his videos. I don't remember which one it is, but ever since he mentioned it, I did remember it. And that leads into the close of the market. Now, you might be asking, what are the silver bullet time windows and how can you use it? If you look at ICT's YouTube channel, you should be able to find videos that talks about a silver bullet. A simple explanation: in that time window, there's going to be a run either for liquidity, a high or low, or it's going to go for an inefficiency, which is your fair value gaps, volume imbalances, stuff like that. In that window, that 1 hour window throughout the day, because there's 4, so there's 4 different chances in a 1 hour window that you can look for a fair value gap to trade, and it's going to run. Screw it. We'll go over one or two. London silver bullet is from 3 o'clock to 4 a.m. So in that 1 hour, you're going to see price either create a fair value gap that is going to come back into and then trade out of and target liquidity, or you're going to see it sweep into an inefficiency and then take off. 3 a.m. here, 4 a.m. here, denoted by the vertical red lines. And then you can see how between this 1 hour time frame, you have a dip into this inefficiency right here. I'll just mark out the whole thing. Or, I mean, yeah, because you can mark that out. Go to that candle, please. Thank you. There you go. So you have this inefficiency that was created right before the start of 3 a.m. And then we have a light consolidation, and then we have a retracement into this inefficiency, and then you see it expand out, come back down, touch the high of it, and then it expands higher, heading into the end of the silver bullet time window. So that's essentially the silver bullet. It's either going to create a fair value gap that it's going to come back into and then expand out of, or it's going to reach into an inefficiency that was created prior to the start of the window, and then it's going to take off. Let's look at the 10 to 11. At the start of the silver bullet time window, you have price expand higher, take out short-term buy-side liquidity here. We create a fair value gap there. And then we also have a bullish order block here. Or you could even focus on this. This is an inversion. This was created prior to the silver bullet. So we have an inversion fair value gap there. We have a bullish order block here. And then we have a fair value gap in the form of a BISI right here. Before the 10 a.m. period started, we have an inversion fair value gap here. We actually even have a breaker here because it's low, high, lower low, higher high. So, I mean, you could even just focus on this if you really wanted to. There's very many PD arrays that you could have formulated this trade idea on. No matter which one you wanted to focus on, either the fair value gap BISI here, or the order block, or this inversion fair value gap. Realistically, I would have focused on something in this area because this is the halfway point of this leg up. 10 a.m. opens up, we run higher, this low to that high is a dealing range. So if you were to split this into premium discount, that would be your range. In this range, you would want to get in as close to equilibrium as possible, preferably in discount. Price didn't end up trading down deep enough. So that's actually a bullish sign, especially if you have all of this price action behind you. We have retrace, and then we took out this short-term buy side. We took out this buy side. We don't have anything back here. That could have been your silver bullet trade up, or you could have taken this. This is actually even better because this, again, this goes into discount of that dealing range, which is actually now up here. So this could have been your silver bullet entry here as well. If you missed this one, then you could have waited for a dig into discount and took that trade. We took out that sell side, and then we also took out this sell side. So we have a short-term sell side liquidity sweep, or if you're bullish, this is a stop run. So this just took out everyone that was bullish since here, and then almost took out everyone that was bullish since down here. So we stopped them out, got them out of their positions, and then we ran it higher. And then we took out this buy side here, short-term buy side there, retraced to that order block, and then we went higher. But you're only focusing on just this hour right here. So this would have been the best silver bullet trade between 10 a.m. to 11 a.m. And the time frame that you're supposed to be looking for this is 15 all the way down to the 15-second chart. So if you don't see a fair value gap on the 15 or an inefficiency on the 15, you drop down to the 5. If it's not on the 5, you go to the 1. If it's not on the 1, you go to the 30-second. If it's not on the 30-second, you go to the 15. That's how ICT explains it. But if you find one on one time frame, then you don't go any lower. You focus on that one. So that is it for the silver bullet time windows. If you're struggling with a time to execute in the market, the silver bullet time windows are a good window to look for trades. We're going to talk about the time macros. Time macros are when price is going to either run for a pool of liquidity or it's going to run for an inefficiency. I should say this is 50, 10, because this is for every hour. So every single hour from whatever hour at 50 to the next hour at 10, that's the time period for that specific macro. And it's every hour into the next hour. So I'm going to remove these drawings, get rid of this indicator. We're going to highlight 50-10 for a few hours, and then we're going to look at it. So looking at these specific windows, what can you see for price? So this specific macro, we went into inefficiency. So we hit inefficiency on this 1 minute chart, 1 minute SIBI. So the macro opened up, dug into that fair value gap, sold off, took out short-term sell side here, didn't take out this low. So failure swing, quick rejection, reversed. And then we ran this short-term buy side. And then we also ran this short-term buy side here. And that was all in this 50-10 time period. If you were anticipating this low to get rated, you could have entered here, shorted it down. Depending on if you got out at that low, you probably got stopped out at break even. Or you could use this reversal, this inversion here, to formulate a trade to take out this buy side and that buy side, just in this macro. So that's one trade, possible break even. Or you could have entered on this inversion here to take out this buy side. And even, well, yeah, potentially this over here, because it did take this out before it did that deep retracement. So inversion, short-term buy side, retracement, bam. And, you know, depending on your stop placement, if you kept it down here, so enter, inversion, stop below here. If you kept it down here, you would have been able to capture this whole move. That's about, you know, if you entered at the high, that's 135 points on NASDAQ. If that was just one contract, that's $2,700 just on one contract using this macro as your entry. And it's the same thing for the rest of them. Macro opened up, dug into inefficiency, went higher, dug into this inefficiency here, took out this short-term sell side here, went higher, took out this buy side here. I don't think it took that out. It took it out after the macro. And then same thing here, 1150 to 1210. So this was just a bullish run. So low, high, lower, low, higher, high. So it used this change in state of delivery here. Didn't even come back down. It kind of just ran higher. Took out, oh, no, it fell short. Fell short of that right there. And then we pulled back. And then we went and took it out there. So in this case, it just ran for external liquidity. This macro started, ran for inefficiency, then it ran for external liquidity, then it ran higher for internal, but it inverted it, and then we ran external from there. And then this one kind of did a little bit of both, right? So inefficiency, external, but that is the significance of the 50-10 macro and how you can use that to formulate your trades. Or if you're already in a trade, then you could look for those macros to take you to your target. And then there's also the 15-15 and 15-45. This is a macro that ICT has given out in one of his videos. Again, I don't remember which video it was, but once he told it to me, I kind of just like ingrained it in my mind. And we will go through that one as well. 15-15 is here. 15-45 is here. So again, look at that. Low, and then as soon as the macro started, it just took off, right? We've got fair value gap there. Looks like it dug into, well, so there's a fair value gap there. Well, inversion for value gap. We have inversion for value gap here, or, you know, if you wanted to focus on this bullish order block, you got that too. If you wanted to focus on that instead. Macro started, took off, expanded, change in state of delivery, fair value gap. It decided to dig deeper into the bullish order block, and then we expanded higher from there all the way here. And then after the macro ended, kind of did a little bit higher, and then it just fell back down. 15-15 here, and then we have 15-45. So same thing here. As soon as the macro started, just sold off. And then once that macro ended, it kind of just consolidated. But for the most part, since the start to the end, it was just a downtrend. And let's see, like this, for value gap there, for value gap here, right? So the bodies didn't even get outside the top of that, and then we sold off, and so on and so forth. You could do it for the rest of the days. I'm not going to do it forever. While I was editing the video that I recorded last night, I just realized that I left out one of the best macros that you could probably trade towards the end of the day, and that's the mock macro, or the market on close macro, and it's 3:45 p.m. to 4 p.m. and I'm not going to show you any examples, but I will overlay ICT's video where he actually talks about it and he shows you a live trade example. So you could look it up on his channel and go over there and watch it. Just wanted to throw that in here before I closed out this video, because this is a macro that I personally love to look for towards the end of the day if I'm trying to get something last minute. But back to your scheduled programming. I challenge you to go into your own charts and look at it yourself and see how price reacted or how price moved in those time frames. And again, all times are based on New York/Eastern time. Those are the times that I focus on. Those are the time-based ranges that I focus on. And that's essentially how I use those different times whenever I'm trading throughout the day. I will see you all in the next video where we start to go over the meat and potatoes of how I trade. So until the next video, bye everyone.